Hi guys and welcome to Finspire. Today in this video we will talk about how to trade around the expiries or the long weekends with some kind of sort of a trading strategies and how you can identify such market trends and how you can trade on such days. So basically in this particular video we will talk about all of these things. First thing first, whenever you are trading in financial markets, you need multiple confirmations. If you're using a trading strategy, you obviously need multiple confirmations. Whether the market is going to be bullish, bearish, or sideways, you have to confirm with the multiple confirmations. So in this particular case, we will talk about how you can take trades in two different type of ways in a sideways market trend. So first thing first, I'll tell you what is basically a sideways market trend. So let's say if you see here in this particular trade, in this particular day here, the market has gone sideways around this particular mean level. So you have to first identify a mean level, which is basically this one, which is 43,400 is the mean level. 43,500 has a very good OI, but 400 is acting as a mean level and is not crossing 500. Okay, so basically 400 is that mean level. And in this particular case, what you can do is you can short that particular mean level on both the sides. So basically you will short the call option and you will also short the put option of that particular strike. This particular way you generate a profit which is basically caused by the theta decay on around those options. If the implied volatility is not picking up, if the implied volatility cools down, then it's a really good trade for you. But if the IV goes up, then in that particular case, it will be a very fierce competition between the IV and the theta decay. Now, in this second cases, you have to identify the range where the market is not going to be. So this is the particular range. For example, for this particular same trade, you have to identify a range. You have identified that 43,500 is the place where market will not go. And then you have to identify this range, which is basically 43,100, where the market will not go. And what you can do is you can short these two ranges, and there will be good theta decay, and if the IV cools down, then everything will be in your favor. Now in both of these two cases, if you short around the mean position, that is generally profitable, more profitable compared to you identify the market is not going to go there, that is slightly less profitable. But the another important point is that if you can identify where the market cannot go, it makes your trading probability even better. Okay, so if you want to trade based on probability, second is the option for you. If you want to capture high profits, first one is the case for you. Now, how to identify all of these things is a part of Inspire Masterclass, where we talk about all of these things in a very greater detail. But let me just tell you very quickly that see here, market has gone sideways. See here, the market has gone sideways. Now we are expecting a trade for tomorrow. So we already taken a trade in our system. Now we are just expecting a sideways market trend tomorrow as well. Okay. Now, what are all the parameters that we are expecting the market to go sideways? Is we basically talk all of these in the masterclass, but here, since our a difference that the idea behind that trade is that market is going to be sideways, so we have taken a safer trade because it's a BTST trade, which is the second option which I just told you. So we have just identified the places where the market will not go. And how did we identify those places is basis of the overall OI data and the final Bhav copy files. Basically, the Bhav copy files, comes out very late by the NSE, but the actual OI data, which was present at around, close to 3 o'clock, we have taken that particular trade. So let me just show it to you how our trade is. And this is our trade is currently is. So basically, the plan is that market is going to be in this particular range, and the particular range is being defined by the highest OI levels, though they are reduced from the previous higher levels. Basically, previous high levels were quite high. Now they are reduced. So we have identified the market is going to be in this particular range, and we have shorted this particular places. So we have shorted 43,000 and 43,500, and we have hedged it, somewhere far around with some, good enough. Okay, for every lot we have just bought one option around there. So we have hedged it with that. Just ignore this one lot because that's a positional trade that we are planning to take for the entire month. Okay. Now, in this particular case, we are clear short for tomorrow that the market is going to be sideways, and we are going to get the benefit of cooling down of the implied volatility, and secondly, the theta decay. So we'll see in morning how it works out, and we'll continue this video as the part 2 of it. And currently, this is the part 1 of the video.